Gentlemen, thank you very much. A quick introduction. Dimitrios Fafalios is the chairman of INTERCARGO and director of Fafalios Shipping. Stamatis Tsantanis is the chairman and CEO of Seanergy Maritime Holdings. Christos Begleris is the co-chief financial officer of Starbulk Carriers. And last but not least, of course, Basil Sakellis is the managing director of Alassia NewShips Management. Gentlemen, we would like to start with, first of all, having a very volatile market. This is one of the general characteristics of dry bulk. We will start with the bad news first, so that the aftertaste will be the good news. There is good news. So keep tuned. We will be finishing with a nice tone, but we will start with the things that challenge us. I think it's best to start from top to bottom and from bottom to top. This market has actually boomed from the wrong side. When we started seeing better rates, they started from the smaller sizes, which is usually not the normal. Usually we see the bigger sizes having better days, and this spills over to the smaller sizes. So I would like a small comment from everybody, really, how you have seen this boom and where we are today.
Thank you very much, and thank you to Marine Money for this lovely event on a great day. Yes, indeed, we've had a very positive market, and the market has been benefited by the let's say the lack of container line contribution towards, I would say, the micro bulk and the general cargoes. So this is a very big question for us. When will this spring unwind? At the moment, although we have lower container rates, we still have significant congestion at the container terminals. So we're waiting to see when the micro bulk shippers and receivers and the general cargo shippers and receivers, which have so benefited the Handy and Supramax segment, we're waiting to see if they will return to the container sector. Thank you.
Good morning, everyone. First of all, big thanks to Mia and Kevin and Andrew and Matt for having us here. And by the way, congrats on the venue. It's spectacular. It's the first time I come here in the daytime and see this beautiful surrounding, so thanks. To the previous point, I would like to say that it looks surreal to see Capesize rates at these lower levels as compared to the other sizes for 2022. I mean, I still don't believe it. I think that we will eventually revert back to the mean, and once various abnormalities go away, we will expect to see the normal pecking order in respect of earnings. Thank you.
Again, thank you to Marine Money, organizers, for having us here today. John, thank you for coordinating this panel. We live in turbulent times. And EU economies, for example, are having big structural problems and are heavily dependent by what is happening in Ukraine, given essentially that they were relying on natural gas being imported from Russia, and now they have to import natural gas and coal from further away. The coal side impacting positively the dry bulk market. The US economy, the data that we get from there are not so bad, but given the Fed having very aggressively raised interest rates, again there's the fear that the real estate market might be in trouble with mortgage rates at 7–8%, and a lot of the acquisitions on real estate being heavily dependent on financing. Now, of course, 41% of the total trade in dry bulk is China. And the situation in China is something that we all very closely monitor. China, essentially, has been in a self-imposed recession for the last 12 months, with the zero COVID policy, but we have started seeing positive signs coming out of that market. Steel exports from China have been 10% down year on year. That's a massive number. That's 6% of global steel exports, effectively. China has been increasing the level of iron ore imports recently, and remains to be seen what will happen after the elections that you have on the 16th of October, and then in March of 2023, when effectively new committees under the same president will take over and implement a new growth program, because China effectively has to come out of the self-imposed recession that it has put itself into for the last 12 months.
Thank you, Christos.
Thank you. Thanks from myself as well for the invitation. It's great to be here. Indeed, the dry bulk market has been great over the past couple of years, and the support from the smaller sizes has obviously been rather unique and extremely helpful, as it's provided a floor for the other sizes as well. I'm not going to complain as much as Stamatis, because as owners of handies, we've had the opportunity to sell some of them. Now, we were all hoping that the dry bulk market, and we think we deserved that the dry bulk market might stay a bit higher for a little bit longer, but this is shipping. We can't get too excited when the market is good, nor too pessimistic when the market is bad. And I think that all of us in the dry bulk market, we lived through the difficult period of 2015-16. We learned the lesson of having higher leverage than we should, and we've all worked very hard to strengthen our balance sheets. Therefore, if the market improves, so be it. Our break-even with the lower debt is much lower, so we'll enjoy those higher rates. If the market doesn't improve and it declines, then we'll all get the opportunity with our strong balance sheets to invest in new assets, as opposed to having to nurture our existing fleets.
Basil, thank you very much. We of course we know inflation is around, inflation is here, mainly in the developing world. We all see the cost of living going up, and we definitely see the energy cost topping up inflation. So there's inflation on inflation at the moment. Usually, central banks have their macroeconomic tools, which means they increase the interest rates and they try to fight inflation. Because now inflation is inflated with the energy cost, do you think these interest rate hikes are effective? Or do you think these interest rates will increase the cost of lending and borrowing, of course, which means that less investments, and we're into a possible recession? And also, how can this affect shipping investments with higher cost, new buildings as well? A lot of questions, so whoever would like to answer on whatever of this question is free. Dimitri, we start with you again, and then we will take the opposite turn from Basil at the end.
Thank you, John. Thank you very much. Very much an economist's question to a shipping panel. Nevertheless, we have to look at the realities. If we look at the new building prices at the moment, the new building prices are extremely high, and at the moment we don't see, because of inflationary pressures, because of increases in energy, we don't see these prices coming down. The shipbuilders are going to keep the prices as high as they can. However, going to the interest rate environment, this also affects, to a certain extent, it also affects the financing of cargoes. And the financing of cargoes is often much more dominant than the financing of ships. So there will be on the one hand, there will be an increased cost of financing the dry cargoes. On the other hand, we've talked about volatility, we've talked about opportunities, especially in terms of the charterers and the dry cargo traders. I see that the increased costs will be outweighed by the increased volatilities and the profitability. So I'm hoping that the there won't be as many negative effects of the increased interest rates. Thank you.
Well, the only thing I want to make, the only additional point is the fact that, yes, everything becomes way more expensive, especially new buildings. This is not the only reason why we don't see a lot of new buildings. It's also the uncertainty about fuels and stuff. But overall, I believe that infrastructure investment will prevail, and that's one of the countermeasures for dealing with higher inflation and all that. So, you know, we strongly believe that infrastructure growth will lead to a much more increased demand for raw materials.
You're giving a good forward about the good news. So thank you, Stamatis. We will talk about the good news later. It will be the aftertaste.
Again, very turbulent times. Given inflation and very high energy cost, the fear here is that we'll move into a stagflationary environment, which of course is very negative for economic growth globally and will definitely affect shipping. I fully agree with Stamatis that essentially ship owners today are not deterred from placing new building orders only because of increased new building prices and inflation keeping those new building prices high. It's the uncertainty on the energy transition and the decarbonization drive that is taking place that effectively keeps us away from ordering vessels that right now cannot comply with the 2030, 40% reduction in carbon intensity or the Fit for 55, 55% reduction in carbon intensity that the EU is going for. But hopefully central banks globally will do their job correctly in order to avoid a stagflationary environment.
Thank you. Yes, increase in interest rates has been the medicine of choice for inflation in living memory anyway, and it does eventually work. The question, of course, is how long will it take to work in the US and in Europe? And of course, since this is a dry bulk shipping panel, we have to, I think about the effect the increases in interest rates and therefore the strong dollar has on all those other economies that the dry bulk shipping depends on, like the Brazils and the Chinas of this world. And therefore, fortunately or unfortunately, once again, my view is that China will be the catalyst for the dry bulk industry in this instance. If they decide to stick to their zero-COVID policy, and if they decide to remain strict with their real estate issues and on infrastructure spending, then you know, the combination of that and the recession in the developed world might result in more pain for dry bulk, at least for some time. If China decides to support their economy by spending, as they have done in the past, then maybe the pain will be slightly less.
Basil, thank you very much. Well, there was a very famous Greek movie that Nikos Kourkoulos was a survivor from a shipwreck. In that famous movie, he had a very famous quote which said, "Όχι άλλο κάρβουνο," no more coal. Today, I think we're reversing 50 years later after that movie, and we're talking about recarbonization, not decarbonization. We're moving back to coal and switching into coal-fired factories. In China, one after the other are reopening. I will pass the question first to Stamatis. Όχι άλλο κάρβουνο.
It's unfortunate to see this reversal. It has been quite good for dry bulk because it has compensated for the reduction of iron ore that we have seen. We believe that coal will be dominant in Europe for the near future at least, whether we like it or not. We are dependent on coal, and like you very well said, there has been 200 new coal-fired power plants in Southeast Asia that have been built the last few years, that are going online now, and they will be delivered in the next couple of years. So, coal is still dominant in the production of electricity. Renewables are not sufficient in order to cover this need. And we see that from our trades. I mean, a few years ago, we had 1 or 2 capes at any given time transporting coal. Right now, 80% or 60% of our fleet is actually transporting coal, mainly to Europe. So that has increased ton-mile a lot. One final point about coal is the fact that European stockpiles appear to be quite full in respect of the depositories of coal, and we believe that once that starts to deplete in the very near future, with winter coming in, we will see much more cargoes of coal coming into Europe once again. So whether we like it or not, we need energy, and coal is one of the cheapest and most abundant forms of energy around. And we will be dependent on that for the near future.
Thank you, Stamatis. Also, this same could apply, of course, to Star Bulk, having a good position with the capes. But from Christos, I would like also to add your benefit on the scrubbers today. It was a very, very good bet. 110 ships, if I can recall, that you installed scrubbers?
120.
120, you see? So
yeah.
it's paying off today, really.
Yeah, let me just touch upon coal first. As Stamatis said, effectively 50 million tons of coal were being transported from essentially Russia into Europe. Those 50 million tons now have to be transported from elsewhere. And given that they're being imported from further away places, there is a multiplier effect which greatly helps ton miles in dry bulk. So we're clear beneficiaries. I mean, the situation with Ukraine has sort of put a brake on decarbonization and energy transition. However, I don't think that 2030 will be pushed back. I think there is huge pressure also outside of shipping for decarbonization. And I mean, we can discuss later. It remains to be seen market-based measures that will be implemented globally in order for decarbonization to be essentially enforced, because we need market-based measures in order for decarbonization to move forward. Yeah, and very briefly on the scrubbers. I mean, effectively, in 2020, IMO gave us the choice of either installing scrubbers or using VLSFO. At Star Bulk, strategically, we took a decision back from 2018 to go into an installation program of 120 scrubbers on board our vessels. This has been a good investment decision because essentially it was paid off, including the off-hire cost, as we publicly declared back in June this year. So it was completely paid off in 2.5 years. And essentially what is being generated now is pure profit and provides great downside for our shareholders. Because essentially in a very weak market, with the spread in Singapore today, it was close to $350 per ton. This effectively generates an additional income stream of $200 million per year for our shareholders, which is significant.
I want to touch upon the subject of scrubbers. First of all, I don't disagree. We have scrubbers on half of our fleet, which we didn't pay for, so they were paid by our charters, and now we're seeing the benefit of the scrubbers 3 years after the installation. So what I want to say about the scrubbers is the fact that it continues to be inexplicable to me why high sulfur fuel is available for sale. You don't see leaded fuel anywhere in the world for cars, so I don't really understand why high sulfur fuel is being sold to ships. So that is something that it should have been stopped years ago. And something more important, in order to operate the scrubbers, you need 2 to 3 tons of fuel per day just to operate it. So that's about 1,000 tons a year of additional fuel that you need to burn just to operate the scrubber. So imagine that times 4, which is the CO2 emission. So I'm trying to understand what's the benefit overall for the environment by having a scrubber. It's good basically because we make profit. You make the whole profit out of it. We make a big percentage of that. But I don't really understand how the environment benefits by the sale of high sulfur fuel that you need 2 to 3 tons per day to burn. That's 1,000 tons a year just to operate the scrubber. So that's something that I really don't understand.
Stamatis, thank you very much. You're very much aligned with what I have been thinking since day one when scrubbers were introduced as an idea. But in any case, today it's paying off. The spread is about 350 in majority of the world and 250 in Rotterdam. So yes, it really pays off. Basil, I have heard very, with very much interest, your opinion about CII and EEXI. So, this is the next question. I will leave last but not least INTERCARGO and Dimitri on CII because I know he's going to stir the water. But first, Basil, your opinion about CII.
Sure.
Just a small note. Are we going to put stickers on the ships like the fridges and the air conditioning, with the rating, and we keep it because it's good, or we take it off if it's, F or...
It'll certainly make
really
your
bad?
life easier, right? You'll just send a photo of the ship with a little sticker on board, and
Actually,
the potential buyer will know.
Basil, yes, I'm a sale and purchase guy. So, the first thing that a new buyer asks, it's not the description of the ship, of course, meaning, consumption speed and particulars. It's GHG and, the score. Give me the score.
Right, so I don't think you'll find a proponent of CII anywhere in this room, which begs the question how it was put in place in the first place. I have there are loads of issues with it. There's short voyages, there's long idle times, but my fundamental issue with the CII is that it focuses on dead weight as opposed to the cargo carried by the ship. But since I am sure that Mr. Fafalios has at least as strong views as I do on this, just to try to see it as half full as opposed to half empty, I guess that the mere fact that we are talking about how both ourselves as owners and our charters and now more often than not the charters clients as well, customers as well, are talking about how we can make our ships more efficient operationally from a CO2 emission standpoint, I guess is a good start. But there's a lot of things that need to change for this operational measure to actually become applicable in real life.
Dimitri, give us your best shot now.
Thank you very much, and I think my fellow panelists have really described the terrible situation which we've found ourselves when confronting CII reality as opposed to CII on paper. CII was an operational measure developed at IMO because basically the technical measure, EEXI, which was effectively reducing the power of vessels and thereby slowing them down, was not really the environmental NGOs didn't believe that the technical measure alone would allow the shipping industry to reach the 2030 goals. And therefore they asked for an operational measure. The CII operational measure was originally developed by the liner industry and submitted at IMO. There was another proposal, let me say, from the tramp bulk sector, which is also a very, very big sector, which we are all involved in this panel. And unfortunately, when it came time to sell the whole package, it was considered that EEXI plus CII was the way forward. It was a political decision, it was a negotiated settlement, and it's an incredibly imperfect settlement. However, there is some hope on the horizon. CII has a trial period until 2026. I hope that in that time we will identify the weaknesses and come up with something far more effective as an operational measure and a far more just operational measure. So thank you very much, and over to you, John.
Yeah, just to leave the good news last, we're seeing that the fundamentals of dry bulk are very good, very low order book, below 7%, 6.7 today. And we see also, we touched on it, Stamatis, you gave a little bit of an insight, infrastructure works, USA, China, and also the reconstruction of Ukraine. Just a very quick word from everybody, and that's how we finish. Are you all bullish about, I mean, and smiling about the future?
Well, we are smiling, but, you know, seeing the Capesize rates really at these levels, you know, make us a little bit cautious. However, we're very positive about the future. We think that having the lowest order book of the last 20 years, this is going to become a very strong factor for the market in the very near future. At the same time, we believe demand will be at least stable, but surely it will have some positive element as well arising from infrastructure. So overall, the fundamentals of the lowest order book of the last 20 years, together with stable demand, I think, and increased ton-mile, I think this is going to be very positive for shipping. And at the same time, EEXI and CII, whenever that works, I think it will also become, it's going to create a supply squeeze sometime in the future. Thank you.
We are cautiously optimistic, and we cannot not be cautiously optimistic when we are at such a fantastic supply environment that Stamatis mentioned, when we essentially should embrace decarbonization, because decarbonization helps us tame the effective supply globally. I agree with Dimitrios, CII needs to change in order for it to be fair, but effectively, in order to comply with an increasingly higher bar on the CII, we will also have to reduce speeds and therefore reduce the net effective supply. We remain cautiously optimistic because we await to see more signs of revival from China. I mean, we have heard about essentially new infrastructure projects. For example, the Shanghai area has come out with 300 billion of infrastructure projects in order to counter the 14% negative GDP growth rate in the second quarter of 2022. But we'll be more optimistic as we see implementation of those projects in order to also see a pickup on the demand side. However, given the supply, we remain cautiously optimistic that the market will be good in the next years to come.
Thank you very much. Very quickly, I don't really have anything to add. The supply side and all the regulations are hopefully going to provide a floor at reasonably healthy levels, and anything above that which will come from demand will obviously be very welcome.
Thank you, everybody. Let's have a good smile and a good photo.